Hi, this is Patrick Adams with this week's Market in a Minute. It's February 7th. We'd like to discuss with you this week the real issue of the stock market. So, this is the thing that the bulls and the bears are debating. The bears believe that the, or maybe the more realistic investors, I should say, believe what the Fed's saying, that interest rates are going above the top end of this graph to 5% or higher and stay there for an extended period of time to kill inflation. So you have to keep the patient on the medication long enough for it to work. Um, the stock market slash bond market believes that come summer, the Fed will be cutting rates, and by early next year, the Fed fund rate might be closer to 4%, or much closer to 4% than 5%. This has a very pronounced impact on the valuation investors are willing to pay for stocks. With the 10-year Treasury at 3.5 or 3.6% currently, if the 10-year Treasury rises, then investors will want to pay a lower valuation for the stock market. If it stays where it is, the 18 times is about right for the stock market. If it goes lower, then maybe the multiple even expands more. So the the issue of keeping rates high for a longer period of time, it will have an impact on the economy. Earnings will grow slower, and likely the valuation will be less than what it currently is because the 10-year Treasury will have to rise in yield because of what the Fed's doing. So Powell speaks today around noon Eastern time and likely will come back and fix anything that he didn't like on his press conference last week, or maybe he might leave it alone. It's a wild card for the market, and it's really kind of odd that we're debating this. The Fed's been very clear. If the Fed does what they say they're going to do, the stock market's likely down probably 15% from where it currently is. Now, you have to look at how the economy is doing as well. So, this is the best economic indicator that we know of. It correlates really well with earnings growth. And as you know, we've been very concerned about the earnings in the first quarter coming down more than the fourth quarter. The fourth quarter was not good. So many companies reported very disappointing earnings. The first quarter is probably not going to be much better, or maybe even worse. The PMI, it is when it's below 50, and the PMI is a survey of purchasing managers. But when it's below 50, the economy is contracting. When it's above 50, it's expanding. And you can go back and look at the prior recessions we've had. It dips at least to the low 40s, and that's where we get a recession indicator and time to buy the markets when that occurs. It's a good buy signal. So when the market comes out of the recession and recovers again, the PMI goes up and the stock market follows it. So we think that the PMI will probably drift down, if not to that 42 or low 40s, somewhere in that range, and then start to rebound perhaps later in the year, depending on how aggressive the Fed gets and how long they maintain that 5% interest rate that they've been talking about. Um, so we're in the camp that the Fed stays tight longer. Earnings will have to come down more than what they are, and that the valuations will actually have to come down as well because the 10-year Treasury will have to go up to follow the Fed funds rate up a little bit. And then we'll set up for a good buying opportunity looking out to 2024. Now, I don't know about you, but I was rather ticked off about what happened with the balloon flying over our country, China spying in such an obvious way. Um, there's a big black swan event out there, as you know, right? If China invades Taiwan, it will cause a severe recession. It'll be a very bad move by China. Um, the long term, short term, however you want to look at it, they are a big economic player. Our economy will slow down greatly, obviously, it'll put the whole globe into an economic recession. This is something we don't want to have happen. There's no way to prepare for it other than having a tactical strategy or a loss averse strategy that can move very quickly if such an event should occur. Uh, the stock that we like to have some exposure on the upside if this would occur would be Raytheon. Very well positioned, um, great company, high quality, still a reasonable valuation. We have Raytheon in our portfolios for this particular reason. Artificial intelligence. Now, there's been a lot of talk about this week with the three A's reporting, Alphabet / Google, um, Microsoft, and Amazon. They're all investing in artificial intelligence. I think it's going to be a big trend. We played around with the Chat GPT software, and I can see why people are excited about it. And so we would like to invest in some pure plays that are out there. I don't really see one at this point. We looked at AI, ticker symbol AI. Um, they have negative revenue growth for this year. They're losing about $100 million per year. It trades at about 10 times revenues, sorry, not earnings, but revenues, 10 times revenues, so very expensive. Um, we don't see it at this point. There's some couple other companies, SOUN, BBAI, GFAI. It's possible these companies could go up, significantly as the market focuses on this area. I would say that it's highly risky, and the way to play it is through some of the larger companies. Um, Thank you very much. I hope our explanation of the Fed funds futures and our outlook and what the Fed is saying was clear. There is significant risk in the markets if the Fed does what they say they're going to do, because the stock market and bond market are not anticipating the Fed to follow through. So we'll know Tuesday, today at noon, and we'll see what the Fed has to say. If you'd like to subscribe to our weekly email, please go to Patrick Adams CFA. That's my website, Patrick Adams CFA, or you can always go to PVG Asset Management as well. And you can sign up for Market a Minute, and we will send you a weekly email that gives more details about what we see happening rather than just this video. Thank you very much.